stock picking works. I believe stock picking with the right process and the right temperament works. And this is what value investing is about: stock picking. How to find and buy stocks that trade significantly below intrinsic value. According to Ben Graham, an investor wants to buy a stock that's worth $1 for 50 cents. What is the process? What's the process that value investors follow? And does this process work? And what does this mean for the future of value versus growth and, in general, about stock prices? So that's why my agenda for the keynote speech is to talk to you about who are the value investors, like where they belong in the spectrum of analysts, what process they follow, does it work, and then extend to the future of stock prices and value versus growth going forward. So who are the value investors, first of all? They are long-term fundamental analysts that follow a bottom-up approach, as opposed to the short-term fundamental analysts who also have a bottom-up approach. And let me talk about the short-term first. The short-term analysts are the typical CFAs. They start their analysis by looking at individual stocks to understand management, sales, cost, growth. And once they do this, they try to figure out what have been the drivers of the stock price historically. Was it GDP? Was it fiscal policy? Was it monetary policy? And depending how these factors are expected to unfold, they come up with target prices. They accept the stock price as correct, and they say, what will make the stock price change? I call them short-term analysts because short-term announcements, press releases, macroeconomic events, they make them react. And you can see this by reading various newspapers and websites. They say many times that analysts anxiously awaiting the release of earnings by, let's say, Intel. And depending on whether Intel meets or beats by 5 cents, they react. And as they react, they change the target prices. Now, we're long-term in the sense that we use long-term fundamentals to arrive at an intrinsic value that is not affected by this noise. For us, whether Intel meets or beats by 5 cents is irrelevant. What's important for us are broader questions. That is, does Intel have barriers to entry? Is there a competitive advantage? Is Intel well managed? Do they have the right business model? Is Intel conservatively financed? Okay, these are specific. These are more general questions that involve no forecast about anything. Depends on how well we understand the markets and the company. For us, the stock price plays no important role. What's important for us is the difference between the intrinsic value and the stock price. And if the stock price is well below the intrinsic value, but what we refer to as the margin of safety, then we buy. Otherwise, we wait. At the time of Ben Graham, the margin of safety was 50%. That's why he said, we buy $1 for 50 cents. Nowadays, more like 1/3 or 1/4. That is, if a stock is worth 10, I will not start buying until the stock hits 6.66 if I've got 1/3 margin of safety. So this is who we are. Now, we believe also that when we buy a stock, we don't buy a piece of paper. We buy a piece of the company. We don't buy as a trader, we buy as an owner. And if you buy as an owner, you've got to understand a lot about the company. And because it's humanly impossible to understand a lot about many companies, value investing implies a concentrated portfolio. Again, different from what it is at the university, where we talk about a well-diversified portfolio. We don't ignore diversification, but we don't emphasize it to the extent that you learn under modern portfolio theory. Second, we believe that the markets move up and down for whatever reason, irrespective of fundamentals. Ben Graham referred to this movement as the market behaving irrationally. And the idea here is not to follow these market movements, instead take advantage of them. When everybody panics, you look for opportunities. When everybody's exuberant, you step back and you're cautious. So we believe price and value differ, which again is against modern portfolio theory and market efficiency, where they believe that price and value are all the same. And third, we believe that you've got to have a margin of safety. The margin of safety protects our downside. We had a legendary value investor talk to my students. His name was Walter Schloss. He died a few years ago. He died at 96. Most of them died in the late 90s. Value investing, as I say, helps people live long. And one of the students asked him, what's the most important thing in investing? And he said, don't lose money. If you lose money, it's very difficult to recover. So value investing, margin of safety, protects your downside. There are many things that happen. Things you know you don't know, and more worryingly, things you don't know. So if you combine some diversification with a margin of safety, you can protect very well against these risks. And one thing that's also very important for us is, unlike, I guess, other risk managers, is that we want actually to minimize risk. We don't want to maximize return. We prefer to minimize risk than maximize return. And the margin of safety protects us, helps us minimize risk. And I want to mention here, because we're in Greece here, one of the first value investors that I think were, and this is Aristotle. Now, Aristotle says something that we espouse as value investors, and it's very important, and it can apply to many aspects of life. So he said, the aim of the wise is not to secure pleasure, but to avoid pain. Okay, so the aim of, if I make this financial, the aim of the wise portfolio manager is not to maximize return, it's to minimize risk. And also in life, if you go through life without pain, you're ahead of the game. So this is who we are, this is what we believe in. What process do we follow? The value investing process has 3 steps. In the first step, we're trying to identify stocks that they look like they're undervalued. And how do we do this? By screens. We screen stocks for 2 reasons. One is to reduce the number of stocks we will examine more carefully later. And second, we want to make sure these stocks selected meet certain desirable characteristics. According to Ben Graham, these stocks are the stocks that are obscure and undesirable. Because the more obscure they are and undesirable, the more chances that will be mispriced. So what is obscurity? Small cap stocks, low analyst coverage. What are undesirable? Low price to earnings, low price to book, pessimism about growth of the company. The Ben Graham investors are opportunistic. They buy and sell. Warren Buffett early in his career, was opportunistic. But then he became too well-funded and rich. He could no longer invest in these stocks. So for Buffett now, his screens are, do the companies have barriers to entry, competitive advantage, sustainability? Even if they violate some of the Ben Graham metrics. Okay, so a stock with a price to earnings more than what the Ben Graham suggests could still be found to be undervalued if the company has sustainable competitive advantage. Now, the confusion here is not only in the public sphere, but also in the academic sphere, is that they think that all that we do as value investors is buy, let's say, low PE stocks. This is not true. We may buy from the low PE sample, but we don't buy all low PE stocks. Because a stock can have low PE because simply it's a bad stock. How do we separate the good low PE from the bad low PE? Well, we take the stocks that we selected and move to the second step to estimate the intrinsic value, and here we try to separate the good from the bad low PE stocks. What do we use for finding intrinsic value? Well, we use two approaches. One is based on the company's assets. It's called net asset value approach. And the other is based on the cash flows of the company, and is known as the earnings power value approach. We end up with two parameters, two boundaries. Where the intrinsic value will lie depends on strategic analysis. So value investing, is like has many aspects. It has finance, has accounting, has strategy, has economic theory, has psychology. What you're going to find interesting is that when we do these two valuations, we do not incorporate growth in our valuations. Because, I show this in my class and in seminars, I show that if you are in an environment where there are no barriers to entry, growth does not add value. And 90 to 95% of companies out there operate in a free entry environment. And for these companies, growth does not add value. Then why should I add growth in my valuation? But for the 5% of companies that operate within barriers to entry, then we incorporate growth in our valuation. So it's not true that value investors don't buy growth companies. They don't want to overpay. And most investors tend to overpay for growth. And the third step is we want to buy what we call the truly undervalued stocks. Which are the truly undervalued stocks? The stocks that meet the margin of safety requirement. That is, intrinsic value minus 1/3, 2/3. So companies that are at 2/3 or less of intrinsic value are the truly undervalued stocks that we buy. And we do this with patience and discipline. So this is the three-step process that we follow. The question is, does it work? Now here I got to explain one thing. Because the evidence shows that value beats growth in the long run, especially for small stocks. And this outperformance happens in every market around the world. However, all this evidence that I have up here is evidence produced by academics. Academics, however, do not know which stocks we tend to buy through the 3 steps. What they know and objectively determine is the stocks that selected from the first step. So what I will show you next, is only evidence about the first step, that is buying all low PE stock as opposed to buying the best low PE stocks. And of course, if buying all the low PE stocks works, imagine how much better it would be buying the best low PE stocks. So what academics do is they short stocks, let's say, by price to earnings. They form portfolios of low PE, second, third, highest PE. Maybe they have quartiles. Sometimes they do deciles as well. In Canada, I do quartiles. In the US, they do deciles because they got many more stocks. So I form quartiles. I've got the lowest PE quartile and the highest PE quartile. So the academics say, well, I don't know which stocks you guys buy from the low PE group, but I know the stocks you buy tend to be from the low PE group. So let's call the low PE group value stocks. And I know you guys, you don't like to buy high PE stocks. So let's call the high PE portfolio growth stocks. Once we make this determination, then we try to figure out what's the return over the next year. Next year, we do the sorting again, try to find the next year returns and so on. And by doing this, we end up with a time series of annual returns for the value and growth portfolios. The difference in returns is called value premium. So what I'm going to show you is bar charts of the first step. If the bar is positive, value beats growth. If negative, the other way around. So here is in Canada, everything's in Canada. Notice how good it was for value investing up to 2002. So that was a very good period. 83 to 02 was a great period for value investing. Then something happened, I guess, after that. And value did not work that well. But again, I want you to understand, because many people said, oh, value is not working. It's not that value is not working. It's the first step. All low PE stocks may not be giving you a good result. It doesn't mean that through following the 3 steps, you can still find good stocks to invest in. But over the whole period, so in the first 10, 15 years was about 10% outperformance. Then after that was 0, actually. It was negative, but not statistically significant. Over the whole period, it was about 5 to 6% outperformance. Now, even in the second sub-period, where value did not do very well, the key reason that that the first step did not do very well was because the large cap stocks did poorly. And if you look at small and large cap stocks, you can see that the large cap stocks have a negative value premium in this period, but the small cap actually did well as well. So the underperformance or the bad performance or the equal performance to growth was primarily because the underperformance of the large cap stocks. And you can see the whole period, 83 to 2018, and then the first sub-period, which was really good for value investing, and then the second sub-period, where the small cap did well, but the large cap did not do very well. If you look at global markets, this is a study by Brandes Institute in the US, and they use deciles. These are the value deciles here, the growth deciles, and they use 3 different metrics, price to earnings, price to book, and price to cash flows. And you can see again that the value did much better than the growth portfolios. It was about a 7% difference. And the period, you cannot see there, but the period that they examined was 1980, 2014. So that's a 35-year period. So the global markets. Here is the US. This is a period where the market did very well in the US. 1986 to 2005. What you see, generally you don't see that value beats growth every year. You see it on average. And in all markets, Amex, Nasdaq, and NYSE, value outperform on average. Amex and NYC about 7%, and Nasdaq about 11%. Now, at this point, someone asked me also, why I stop at 06? Okay, let's look at a longer period. This is the chart that Kim loves. This is from my book, page 48? 48. She even remembers the page. So this goes from 66 to almost 2020. And what you see is that value really did very well. Value did very poorly. Growth outperformed very much. In fact, in the US, the rest of the world was not such a big underperformance of value, but in the US was big underperformance. And there are many academic papers that say value is dead. But again, they confuse value investing versus the first step. The process versus the first step. And as I said before, you can have the whole low PE stocks on average doing poorly, but it doesn't mean you can still not find a few stocks that are really undervalued and good. But there was another period over there. If you look at back in 66, there's another 10-year period where value underperformed. And people back then were saying that value is dead. Well, look what happened in the next 40 years. Value severely outperformed. So the question is, would the next 40 years be green or value will outperform? So that's something to think about. The other important thing from this chart to see is this line, this dark line. This line reflects inflation, and by extension, interest rates. Look when value underperforms. They underperform when inflation is low, and by extension, interest rates are low. So you have to ask yourselves, what will the future look like? If you believe that inflation will go back to what was the last 10 years, and interest rates, then value will not do well. But if you believe inflation and interest rates will remain higher than what was before, then value will outperform. So let me show you some numbers to show you the consistency of the numbers with this chart. During the Cold War years, between 66 and 91, when inflation was 4.3% in the US, value outperformed by almost 11%. Between 08 and 20, when inflation averaged 1.7%, growth outperformed by 4.2%. These are very consistent with the graph. If you look at longer periods, if you go between 2030 and 2020, and you split this 90-year period in 10-year non-overlapping periods, the three 10-year periods with the highest inflation was 40-50, 70-80, 80-90. The median value premium in these 10-year periods was almost 8%, 10%, 14% value premium. If you look at the years, the 10-year periods with the lowest inflation, 30-40, 50-60, 10-20, the median value premiums were -2, 2, and minus about 3%. Okay, so if we expect inflation to remain high, then there's no doubt in my mind that value will outperform. So what happened? Let's do a historical overview. Let's see what happened the last 30 years? And what can we learn from that for the future? Here's a historical overview. The fall of the Berlin Wall, the breakup of the Soviet Union, and the end of the Cold War, 1989-91, ushered in a new era of globalization. The admission of China in the WTO in 2001 completed the picture. Globalization shrank the world, increased trade, free movement of products, people, ideas, technology. The world became wealthier. But as a result of the globalization, many citizens of the developed world were displaced by labor forces in China and India. Manufacturing jobs disappeared in developed countries, and they moved to developing countries. Canada lost 51,000 auto-related jobs between 2000 and 2015 to these countries. The increased pool of cheap labor from China and India drove wages down or prevent them from rising in the developed countries. Increased integration and openness led to weakening of workers' bargaining power. Strike action declined. Unions, including the very militant unions of the auto manufacturing in the US, the UAW, they made concessions to keep the jobs. At the same time, friendly government policies, tax-friendly policies, helped reduce corporate taxation. From the Reagan years, taxes in the US were going down. In the Trump years, taxes went down from 35 to 21%. This increased profitability, cash flows for companies. Increased global trade, lower labor costs, reduced taxation, kept inflation low, and interest rates, and benefit the bonds, real estate, and particularly stocks. S&P margins rose from 6% in 2000 to 10% in 2019. Stock prices and profit margins are highly correlated, so the stock market did very well. So this is what happened, a historical overview, which I think has good, very important implications of what's going to happen down the road. So what's next? In my opinion, the secular trend towards globalization has ended with predictable long-term, and I want to stress long-term, I don't care about the business cycle. Like if there's a recession, things can be different, but in the long run, adverse effects in the long run for inflation, interest rates, and bonds, real estate, and stocks. Why am I saying this? Well, notice the similarities with previous end of era periods of globalization. A pandemic that has been likened to a war, challenged globalization by large players, Russia and China, rising protectionism and economic stability and inflation. These don't augur well for globalization. Recently, BRICS have announced that they're going to expand their club. This is a certain challenge against the US and will increase fragmentation of the world. And Trump says that when he's elected, he's going to impose a 10% tax on imports in the US. COVID brought forth a new wave of nationalism in the world, with industries moving back to their home countries, as we see in Japan and the US. Nearshoring is the key word now, or companies are coming back to their home countries or close to the home countries to secure supply chains and national security reasons. And if you look back in history, wars tend to end globalization. The previous big wave of globalization ended with the First World War. And so I think the events in Ukraine are organizing a new Cold War, which will further challenge globalization. What are some of the results of all this? Global trade is on a decline. Global trade has been falling at a faster pace since the pandemic. I mean, the pandemic, there was no global trade, but now it's falling as fast as in the pandemic. In fact, trade has been going down since 2018, and the Trump wars, I guess, worsened things. To give you an idea, in Canada, exports volume was rising in the 2000, was rising at 12% a year. Next year, they expect to grow by only 1.4%, from 12% to 1.4%. And as you probably know, Chinese exports are plummeting. They were down 15% recently. The effect of China on globalization benefits is also eroding. And maybe Ronald can clarify some of this in his presentation. Cheap Chinese labor has come to an end. Since 2000, Chinese manufacturing costs have grown by 16% per annum, outpacing productivity growth, which is about 10.4%. And of course, this has bad effect on their exports too. A recent survey of 260 global supply chain leaders by Gartner found that 33% of them had moved or planned to move manufacturing out of China, North America, to a higher cost environment. What does this mean for inflation in the near future? Now, Biden, in his State of the Union address, he said, I want to bring production back to the US. Recently, he gave an executive order preventing venture capital to go to China. He offered over $40 billion to incentivize the development of semiconductor manufacturing in the US. And so we see Intel building a multi-billion-dollar fab plant in the US. The only problem they have is they cannot find specialized labor. Apple recently announced a multi-billion-dollar deal with Broadcom, a semiconductor manufacturer, because they're trying to stress and show how much they're bringing production back to the US. And the US, and Biden hopes that the US will become self-sufficient in semiconductor chips within 5 years. Now, our sense of manufacturing in North America is increased demand for labor. And since there are not enough workers to fill the jobs, wages are rising at the fastest pace in 4 decades. US lost, in 2020, the US lost 20 million jobs, either because they died because of COVID, retiring baby boomers who are replaced by younger people who are not enough. So there's demand-supply imbalance. In fact, in the US, at this point, there is 1.5 jobs for every unemployed person. And so in the US, wages are rising at 5%, double that of 2019. In the UK, wages rose 7.3%, the largest increase since 2001. In Canada, average wage settlements were up 5.2%, the highest level in half a decade. Unions now are regaining their lost bargaining power. And of course, they're negotiating better wage settlements. Strikes are up in Canada and the US. In fact, in Canada, there were 78 major strikes the first 6 months of 2023. The share of labor in GDP has been increasing. I think this US number was up to 45% last year as opposed to 42% in 2013. The era of declining taxation is over. Going forward, pandemic-related deficits and ballooning debts will require higher taxes. Remember, I said before that the pandemic was likened to a war. What comes to the wars? Deficit increase, debt issuance increases. Well, if you look what happened in the First and Second World War, tax in the US went up to 94%. 94% marginal tax rate. I don't think it's going to go to 94%, but I think tax will be going up to fund all these deficits. And of course, you also have fewer workers to support retired people, and this will also require higher wages, higher taxes. Since 2009, the US has added over 20 trillion in debt. Okay, 20 trillion. The previous 14 years, 5 trillion. Okay, so 5 trillion versus 20 trillion. The federal government owes now 33 trillion outstanding debt. What's the result of this? Debt service charges are skyrocketing. That 14% of tax revenues go to pay for interest. Okay, this is a huge amount of money. They don't leave a lot of money for health and education and so on. Okay. Years of investment in the oil and gas industry, heavy regulation because of ESG has shifted not only the dynamics of oil and gas, but also of other commodities. Mining companies don't invest money in exploration and other things, but instead they just pay higher dividends and capital and buy back shares. What this means is shortages going forward. Okay, with EV and renewable energy, the demand will increase when the supply will not be there. And the US also, another piece of information here, the US has drained its strategic petroleum reserves. They are at the lowest level in 40 years. It's 50% of what was 3 years ago. This is what the US needs for emergencies. So what's going to happen is they have to replenish this. Well, what will happen to prices if they start buying back oil? So just quickly, I guess, profits margin will be eroded. Inflation will also be higher than what prevailed in the past. And so are nominal interest rates. I want to stress here, nominal interest rates change not only because of inflation changes, but also because of real interest rate changes. So not only inflation will be higher, but also real interest rates, the trend in the long run of real interest rates are on the way up. In the long run, real interest rates are determined by the demand supply of capital for long-term investments. What drives the demand is technology. What drives supply is demographics. Baby boomers are retiring. They are de-saving. They're not saving anymore and making investments. At the same time, corporations will be demanding more and more capital for all these new technologies. You think AI will be cheap? EV, renewable energy, the demand for capital will be increasing. At the same time, the supply will not be increasing. To clear the imbalance, real interest rates go up. Not unlike what happened in the late 70s. So not only you have inflation higher, but also real interest rates going up. The effect of higher interest rates on stocks, along with the erosion of profit margins, will have a negative effect on stock prices, as opposed to the positive effect they had the last 30 years. I think this will be more unfavorable for growth stocks, which will be hurt the most because of deglobalization and higher interest rates, inflation. The growth stock underperformance will affect the whole market because now their share of technology has increased. This does not mean that individual stocks will not do well. I think stock picking and fundamental analysis will be key to outperformance going forward. I think value will outperform growth, and riding the ETF bandwagon will not work.